Okay, so where do we start? Asymmetry.
Yeah, let's start with asymmetry finance. The sources present them with a focus on user-customizable stablecoins and yield products, built on Liquity V2 tech.
Okay, Liquity V2. Interesting base.
And their tagline, or value prop, is stablecoins, your way. That immediately suggests, a different kind of user control.
Control. Okay, and then Ethena.
That will shift to Ethena. Their focus, according to the material, is a synthetic dollar designed not to rely on traditional banking. Very crypto native.
Uh-huh. Avoiding the legacy system issues.
And they offer something called the internet bond. Their value prop is digital dollars for the internet economy. Right. Points toward censorship resistance, scalability.
So two really distinct approaches to similar problems: stable value, yield generation, and DeFi.
Exactly. Let's dig into asymmetry first, see what the material says makes them unique.
Okay, so reading through this, one of the first things that jumps out about asymmetry is, well, something described as a fundamental shift. User set interest rates.
Yeah, I saw that. That's different. How did that actually work for someone using it?
Well, instead of the usual variable rates that bounce around based on the market or whatever, asymmetry lets borrowers set their own fixed interest rates.
Seriously, you choose your own rate.
That's what the material says. When you borrow against assets like Bitcoin variants, WBTC, CBBTC, TBTC, or even specific yield-bearing stablecoins, they list SFREX XUSD, SCRAR VUSD, SDAI, SUSD, SUSDS.
You can change it later.
Apparently, yes.
Hey.
Modify your rate and your loan-to-value, your LTV, anytime. It really does seem to shift control towards the borrower, like their tagline suggests.
Wow, okay. That is a novel approach. And this is built around their stablecoin, USDF.
Exactly. USDF, described as an immutable synthetic dollar built on Liquity V2.
Immutable forever, the material claims, and leveraging that Liquity V2 base. What about the backing?
The sources mention high-quality assets, those Bitcoin variants we talked about, plus those yield-bearing stables.
And they see a big market for this.
Yeah, the sources cite a potential target addressable market of $41.8 billion. So they're definitely aiming high.
Okay. And looking ahead, the material mentions another product coming soon, AMP-USD.
Right, AMP-USD. This one's described as a groundbreaking, inflation-resistant CDP stablecoin.
CDP collateralized debt position, like MakerDAO's DAI,
Yeah.
but different.
Well, the source highlights it as an industry first because the plan is for it to be backed by AMPL and SEPIOT collateral.
AMPL and DISBO. Okay, that's unusual collateral.
And the expected yields mentioned are pretty eye-popping, averaging 15–40%.
15 to 40%, wow.
And it also uses that same asymmetry Liquity V2 license, so it should also offer those customizable borrowing rates, plus designed to be immutable.
Okay, so beyond the stablecoins, they've got yield generation stuff too, right?
Yeah.
Optimization tools.
Yes. Auto-compounding vaults, presented as offering high yield, real yield, transparent.
Real yield. That's a term we hear a lot. What do these vaults do?
They accept USDF and the upcoming AMP-USD. And the clever part, according to the material, is they automatically split your deposit optimally across the underlying stability pools.
So it handles the complex stuff for you, harvesting, compounding.
Exactly, a one-click earning solution. And importantly, it says they're always redeemable with no cooldown period.
No cooldown is definitely nice. DeFi users hate lockups usually. What about Etheth?
Etheth, that's their high-yield Ethereum staking product.
High-yield e-staking. What's the target?
The goal mentioned is a sustainable 10% plus yield on ETH, which, yeah, the material claims is roughly 3x the regular staking rate.
How do they achieve that?
It's built using staked Frax Ethereum, SREX ETH, and it leverages the curve and convex ecosystems. They use something called the asymmetrical allocation algorithm AAA to manage it.
Okay, and performance.
The figure given is 8.8% APY for ETH right now.
And there's risk mitigation mentioned. Something about CVX.
Yes, exactly. The sources say they address potential CVX price correlation risk by limiting the allocation to convex to 30%. Sensible.
Which leads us, I guess, to AFCVX, their convex optimization product.
Ah, yes, AFCVX. The sources are pretty bold here, calling it the ultimate CVX supercharger and promising the highest yield of any convex wrapper.
Okay, high claims. What's the key advantage they highlight?
This is where it gets really interesting based on the material. They claim instant liquidity with no mandatory 16-week lockup for AFCVX.
No 16-week lockup for convex staking. That's huge if true.
Right. Positioned as the first ever instant liquidity product in convex staking, That's a massive differentiator from the usual VLCVX lockup.
Definitely a big deal. What kind of yields are they talking about?
The material suggests nearly twice the yield of the competition and shows a current performance figure of 25.21% APY.
25%.
Right.
Wow. And this ties into Convex's role in DeFi.
Exactly. It leverages Convex Finance's power as a governance aggregator, especially its influence over protocols like Curve, because it controls so much CRV.
Okay, so putting it all together, Asymmetry's yield philosophy seems to be all about real yield.
Yeah, the sources really emphasize transparency, sustainability, composability. They explicitly reject those models propped up by just printing inflationary governance tokens.
Saying those models have ultimately failed.
It's a strong stance. Seems like a core part of their identity yield that isn't just based on inflation.
Makes sense. And governance,
Yep.
managed by the ASF token.
Yep, ASF governs the protocols, the products. Holders vote via delegation using VASF, the usual vote escrow model.
And locking ASF gives benefits.
Potentially boosted yield and maybe a share of protocol revenue, subject to governance passing it, of course. The current market data provided is price 1.55, 10.4 million circulating supply out of 51 million max, so about 20% circulating.
So summarizing Asymmetry's market position based on the sources, what are the key advantages they push?
The material points to a few unique things. Those user-set interest rates, first ever apparently, integrating Bitcoin variance as collateral, supporting other yield-bearing stables, and that no lockup instant liquidity, especially for ACVX. That's a standout feature.
Okay. But there are always risks in DeFi. What does the material mention for asymmetry?
For sure. The sources acknowledge the usual suspects. Technical risks like smart contract bugs, dependency on the underlying Liquity V2 system.
Integration risks, too, with Curve and Convex.
Yep, those were mentioned. And market risks as well. Things like CVX price correlation potentially hitting AFIF and ACVX yields, although they mentioned mitigation.
Like that 30% cap.
Right. Plus, interest rate volatility, even if users set rates, overall market behavior matters. And of course, collateral price volatility, especially for something like Bitcoin. Standard DeFi risks, really.
Got it. What about timelines? Anything upcoming?
The sources mention a potential mainnet launch targeted for May 28, 2025. They see that as a possible catalyst for ASF and also LQTY, the Liquity token.
And that AMP-USD launch.
Yeah, that's anticipated, with those high expected yields. And an Ahula staff vault listed as coming soon with an estimated 16.32% APY. Future stuff seems centered around the ASF token.
Okay, so it's clear Asymmetry is focused on user control, integrating diverse assets, and sustainable real yield, as they define it, a very specific niche.
Definitely seems that way, building methodically on that liquidity base.
All right, that gives us a really solid picture of Asymmetry Finance. Let's completely switch gears now. Let's dive into Ethena.
Okay, Ethena, the delta-neutral synthetic dollar people.
Exactly. Their core idea, as we mentioned, is USDD. The sources call it a crypto-native solution for money not reliant on traditional banking. Stability via delta hedging.
Delta hedging. Sounds technical. Maybe break down how the material explains that mechanism.
Right. So the basic idea they present is designed to be straightforward. One USD is backed by having essentially $1 worth of a spot crypto asset like ETH or BTC.
Okay, long the spot asset.
And an equal size short position in a perpetual futures contract for that same asset.
Ah, so long spot short perp. Got it.
So when users deposit approved assets, ETH, BTC, stables, even SOL now, after governance vote, Ethena opens these equivalent short derivative positions.
To balance out the price movements.
Precisely. It creates what's called a delta-neutral portfolio. The goal is if ETH price goes up, the gain on your spot ETH offsets the loss on your short future. If ETH price goes down, the gain on your short offsets the loss on your spot.
So the net value of the backing stays stable around $1 per USD, ideally, regardless of price swings.
That's the design. And a crucial safety point from the sources is their use of off-exchange settlement, OES.
OES. How does that work?
With third-party custodians like Copper and Clearloop, the actual deposited assets, they're held off the exchanges with these custodians.
So the assets aren't sitting directly on Binance or OKX?
No. Only the account balances are mirrored to exchanges like Binance, OKX, Deribit, Kraken to provide the margin needed for the short positions. This is meant to seriously reduce the risk if an exchange goes bust.
Okay, that makes sense. A key risk mitigation step. And USD itself, it seems to have scaled incredibly fast.
It really has. The sources talk about significant circulation with over $21 billion market cap. That's huge. And operating across 24 different chains.
24 chains. Wow. And it's built to be censorship resistant, scalable.
Very scalable because derivatives markets are so deep. Composability across CeFi and DeFi is also highlighted. You can get USD from AMM pools, or approved market makers can mint redeem directly after KYC, KYB.
And the collateral types they accept, you mentioned ETH, BTC.
Yeah, Ethereum LSTs like Steth, Bitcoin, which the material says makes up a big chunk, 41% currently, liquid stables like USDC, USDT, and yeah, Solana now too.
Okay. Now what about the yield side? SUSD,
Right.
the internet bond.
Right, SUSD. The yield-bearing version. Think of it like an on-chain crypto-native savings account, as the material puts it.
An on-chain savings account. How does the yield actually get to the holders? It's a staking mechanism. You stake USD, you get SUSD back. The yield Ethena generates, it accrues directly into the value of SUSD relative to USD.
So the exchange rate between SUSD and USD goes up over time.
Exactly. The sources give an example. Stake 1,000 USDD. Get 1,000 SUSD. If the rate goes from 1.0 to 1.2 year because of yield, you unstake and get back 1,200 USDD. The yield is baked into that rate increase.
Got it. Simple enough concept. And there's a minimum staking period.
Material mentions 7 days minimum, but redeemable anytime after that.
Okay. Now, the crucial part, where does that yield come from?
Good question. The sources point to two main sources. First, staked Ethereum yield.
Right, from the ETH collateral they hold. But you said ETH isn't the majority of the collateral?
Correct. Staked ETH yield comes from the consensus layer rewards and execution layer fees MEV, but the sources note staked ETH is only about 6% of their backing assets right now. So it contributes, but it's not the main driver.
So what is the main driver?
The primary source, according to the material, is the derivatives funding and basis spread.
Ah, the funding rates from those short perpetual positions they're holding.
Exactly. Because they are short perpetuals while holding the spot asset, they collect the funding payments that traders often pay to maintain short positions, especially when the market is bullish and funding rates are positive.
And historically, how has that performed?
It's been variable, as you'd expect. The sources show around 16% APY back in 2021, but then it dropped way down to 0.6% in the 2022 bear market, then back up to around 9% in 2023 and around 13% so far in 2024.
So highly dependent on market conditions. What about right now?
The sources highlight current performance as quite high, over 17% APY for SUSD staking currently.
17% is attractive.
Definitely. They even mention a peak over 100% APY in early March 2024. The recent 30-day average is around 19%. But again, super important to remember this relies heavily on those funding rates staying positive. That's the key risk.
Makes sense. What happens if funding does turn negative? Or during other big shocks, do they have a buffer?
Yes, that's where the insurance fund comes in. The sources describe this as a critical safety net. How does it work? It holds reserves built up from past positive yield periods. It's designed to absorb losses if funding goes negative for a while, act as a buyer of last resort for USDD if needed, and provide a buffer against liquidations.
Okay, a safety cushion. What about governance? Ethena token?
Yep. Ethena is the governance token. Holders vote on big decisions like electing the risk committee every 6 months, approving new collateral like SOL, or deciding how reserve funds are allocated.
Like allocating to that BlackRock BYDL fund.
Exactly. That was a governance decision, allocating a slice of the reserve fund to an RWA, like BUAD.
That is also Ethena.
Ethena is the liquid staking version of ENA. Lock up ENA, get Ethena. It's designed to accrue value, kind of like how BNB works, and stay composable in DeFi. Holders earn rewards, initially from unclaimed airdrops.
Any other benefits for Ethena?
Yeah, the plan mentioned is for staked ENA, SANA holders, to get 15% of the future token supply from Ethereal that's a decentralized perp exchange Ethena is integrating. Plus, integrations with Symbiotic for restaking and Layer 0 for cross-chain stuff are meant to benefit SANA holders too.
Okay. Tokenomics for ENA. Anything specific in the sources?
Total supply, 15 billion ENA. Distribution breakdown, 30% core contributors with vesting, 25% investors, 15% foundation, 30% ecosystem development like airdrops. Current data given. Price around 0.36, market cap $2.18 billion, circulating supply just over 6 billion, so about 40% circulating.
All right. Now, the risks and challenges for Ethena, the sources seem pretty open about these.
They do. The number one risk highlighted is funding rate risk.
Right. The main engine of their yield could stall or reverse in a bad market.
Precisely. If funding stays negative long enough, yield could vanish or even cost the protocol money, eating into that insurance fund.
What else?
Counterparty or exchange risk. Even with OES holding assets off exchange, relying on CEXs for the hedging still carries some risk if an exchange has major issues, though they use multiple exchanges to diversify.
And liquidation risk.
Also mention, While they say they use low leverage and collateral haircuts, a really fast, deep crash in collateral value combined with negative funding could, theoretically, strain the system's buffers and potentially trigger liquidations.
Specific collateral risks, too.
Yeah, like the risk of Steph depegging significantly from ETH, basis risk, the fact that Bitcoin collateral doesn't earn staking yield, which might dilute overall returns slightly, and concentration risk if they rely too heavily on one type of LST, for example.
Makes sense. Standard risks, but amplified by the scale and the specific mechanism. Yet, despite these risks, their growth has been explosive.
Truly remarkable. The sources note TVL jumping from $178 million to $2.3 billion in just 60 days earlier this year. That $21 billion plus USD market cap, 24 chains. It's staggering adoption speed.
And how do the sources position Ethena against other stablecoins?
Compared to fiat backs like USDC, USDT, they emphasize USD's DeFi composability and censorship resistance. Compared to over-collateralized ones like DAI, they highlight the capital efficiency needing only 1.1 backing for the hedge, not over-collateralization plus scalability and the active yield generation.
Okay. And future plans mentioned.
Several key things: that ethereal perp DX integration, more cross-chain growth, integrating more RWAs like the BUIDL allocation, diversifying collateral further, enhancing yield strategies, and potential institutional adoption down the line.
A very busy roadmap indeed, aiming to really cement their place.
Seems like it, building on that initial momentum.
Okay, so let's try and bring this all together for the listener. We've looked closely at Asymmetry Finance, building on Liquity V2, offering that unique, user-customizable borrowing.
Leveraging diverse collateral like Bitcoin and yield-bearing stables, and creating some cool yield products like that instant liquidity AACVX.
And then we examined Ethena, building a highly scalable, crypto-native synthetic dollar, USDD, using that complex delta-neutral hedging strategy.
With yield mainly coming from derivatives funding rates, access through their SUSD internet bond, which has shown some very high APYs at times.
They're clearly tackling similar problems, stable value, crypto yield. But wow, are they taking fundamentally different paths, technically and philosophically?
Absolutely. Asymmetry feels more focused on user control within established DeFi ecosystems, leveraging diverse existing assets. Ethena is about building a new kind of scalable structure using derivatives market dynamics.
And understanding these different models is just so important for you as someone trying to navigate this space. They really represent innovative approaches, potential alternatives, or even supplements to TradFi and older DeFi options.
Yeah, the scale Ethena hits so quickly is a major data point. But then Asymmetry's specific features, like user set rates or the ACVX instant liquidity, offer really distinct advantages for certain users or strategies.
It just highlights there's no single right way to build these financial tools in DeFi. But, as the materials made clear for both, novelty brings complexity and risk.
Definitely. Understanding the mechanics, how does delta hedging really work? What are the specific collateral risks? Where does the yield actually come from, and what makes it go up or down? That's critical before engaging.
You absolutely have to understand the engine before you get in the car. These are complex systems.
Couldn't agree more. The risks need serious thought.
Okay, so recapping our deep dive based on the sources: Asymmetry Finance, customizable borrowing, diverse collateral including Bitcoin, unique yield products focused on real yield, and features like instant liquidity. Ethena, delta-neutral synthetic dollar USD, scalable hedging, high yield potential via the SUSD internet bond, fueled by funding rates. Two very different, very interesting value propositions.
Both definitely pushing the boundaries in the evolving DeFi landscape.
Which leaves us and you with a pretty compelling question to think about. As decentralized finance keeps building these more and more sophisticated alternatives to traditional finance, how is this competition and maybe coexistence between fundamentally different models for stable value and yield going to shape the future of digital money?
Yeah, will one model eventually win out? Or is the future a diverse ecosystem with many different strategies thriving side by side?
Something to mull over. It's a fascinating time to watch this space evolve.
It certainly is. Seeing how these protocols adapt and grow will tell us a lot.